So there were last 5 theory questions, some theory questions pending in the impairment chapter. Okay, so first we'll complete that, then we'll move to the next chapter. And before we complete, we'll start with the theory. Okay, so I'd just like to discuss about the goodwill allocation. Okay, last problem we were solving is about that goodwill allocation, then gross up, this, that. Confusion was not there, but bit confusion was there, correct? Okay, now I have prepared this chart, understand this. See, now first thing starts with the calculation of the goodwill. If they give you in the problem, well and good. If they don't give you, you have to calculate, and we know that the calculation is going to come from 103. It has nothing to do with 36. Now it can happen that goodwill might have come from the full goodwill method or partial goodwill method. Now once you get the goodwill, first you see, okay, is this goodwill can be allocated, because see, goodwill we are talking at the CFS level. At CFS, my parent and subsidiary are one. So there are so many number of CGUs. So I will look for allocation at the CGU level, because goodwill I cannot impair on its standalone basis, because goodwill will not earn any cash. So probably I may give 0 to parent CGU. Say for example, 900 rupees comes. I may give 0 to them, or entire 900 to the subsidiary, or I may give parent CGU 500 and for this 400. So that is what that allocation is told in the question to you. None of the question you will distribute based on the carrying value and all. It is only the head office building you distribute based on the carrying value. Now after this, okay, it should be again, what is subsidiary? Subsidiary means again subsidiary has got 3 CGUs there or 5 CGUs, whatever. Now there should be again a reasonable allocation, and which they would have told you. Say for example 2:2:1. On what basis? Leave it, no, because they would have told you that. They would have figured out like who is going to benefit from the goodwill. All these things they would have figured out. Now you go and allocate, and but before allocation, okay, so you will test, is any of the individual CGUs impaired? Yes, say for example this is impaired, these two things are not impaired. You allocate, and after allocation you test for impairment now. And after allocation you find that this is not impaired, only this one is impaired, and this one is by default it is impaired. And maybe after goodwill allocation again impairment amount may be more. Say for simplicity sake, otherwise it's the same thing. My chart would have been a little bit complex there. I am telling that no, in that also there is a goodwill impairment and all. For simplicity sake, that this is only PP impairment, which we have done first before allocation of the goodwill. Now once you, and same process happens at the parent level also. So I am not repeated this slide at this side, because it is the same thing, because it doesn't matter it is whose CGU there. At the CFS level it is one CGU. Now I will go to the goodwill. I will see this impairment is two. One is the goodwill portion, another is the PP portion. And there would have been independently certain things would have got impaired before you allocated the goodwill. That is, say, for a simplicity sake, we said PP. See, if it is a PP, by default you will distribute to parent and NC. There is no choice there, no question. Why? Because when the NC came to you, you have given them. You have one share of their PP. But when it comes to goodwill, how should I allocate the goodwill? That depends upon on day one when you calculated which method of goodwill valuation you followed. So if you would have followed a fair value, full goodwill method, no headache. The way you distributed PP, you distribute the goodwill also, because goodwill has got the share of both the parties there. But if at all it is partial goodwill method, that means partial means NCA has never no share right from the beginning. How can you distribute now? So NCA will not get anything, but the parent, what they are going to get, they have to gross it up. So you have to gross up. So this goodwill, when you would have allocated for the testing for impairment, you would have, if it was a partial goodwill method, what you would have allocated was a grossed up goodwill, and then finally you take 80% or whichever percent your share of goodwill. Perfect. Clean? Understood? Okay. So again, while practice this, you apply this for the examination questions. You see that the examination questions are done in this particular pattern only. See, there can be more permutation combination. Okay, one question I'll ask you. What if you allocated goodwill here also 500? There is an impairment. There is no impairment here. There is an impairment. In this impairment, there is a goodwill impairment. There is a PP impairment. When the CGU of the parent is going to get impaired, okay, will you distribute anything to the NCI? No. Very good. Understood? And when the goodwill of the parent has got what allocated to parent got impaired, will you distribute anything to the NCI? No, again, that depends upon which method of goodwill you have followed. See, when you talk about goodwill is at the consolidation level, no? At the consolidation level, if you have followed original, again, this type of questions are not there for you. That's what I told you, no? Simplicity, you just focus on this particular portion. But if it is the goodwill at the full goodwill method would have been followed, they have got a share, no? Again, that requires more research, like getting into what exactly the status, like what is the substance. Yes, again, you may have to allocate. See, because in FR, financial reporting, it is not a rocket science, no? It goes more with the judgment. What exactly is the status? Does it make sense? If allocation. Yes, so now this is the last thing we were solving. Okay, now let us discuss some important theory questions which are highly probable for your examination. Okay, so we up to question number 4 we had already discussed. Now a machine has suffered a physical damage, but it is still working, although not as well before its damage. The machine's fair value less cost to disposal is less than its carrying amount. Yes, definitely. Once it gets damaged, you cannot earn cash as earlier. You are obviously, no, your fair value will be less than the carrying amount. And it does not generate independent cash flow also. That means what you cannot get? Value in use you cannot get. The smallest identifiable assets that includes the machine and generate cash flow are largely independent of the other assets in the production line which the machine belongs. That means this machine belongs to one CGU in simple. The recoverable amount of the production line shows that the production line taken as a whole is not impaired. That means the CGU to which that production line is the one to which this machine belongs. Machine cannot earn cash on its own, but production line as a whole it will earn. Now you recognize this, what is that called? You test the impairment for the CGU. CGU as a whole is not impaired, but your machine got damaged. Now there are two assumptions. When you as an auditor you look at the budgets and the forecast approved by the management reflect no commitment to replace the machine. So they said, okay, no, it is damaged, let it remain. Anyhow, my production is happening. Like for example, I gave you that the example of one fan. One of the fan got hit by the lightning and it is not functioning as before. Now other things are fine, no. So if all the 4 are gone, then obviously I am left with no choice other than replacing. So what I may do, one of the fan I will just keep, no. So I don't have any intention to replace. This is one assumption. Budgets and forecast approved by the management reflect a commitment to replace the machine and sell it in the near future. The cash flow from the continuing use of the machine until its disposal are estimated to be negligible. Advise accounting of the impairment loss in the above scenario. Yes, is the one odd theory question. Okay, I think somewhere we were discussing one. We discussed that no impairment loss of the individual assets if the related CGU is not impaired, even though its book value is less than that. Again, that means fine, no. As a whole, we are earning cash because independently that fan never earns cash. That fan will earn cash along with all other related resources. Now, I don't have any intention to replace, or I have got an intention to replace. But since my CGU itself is earning cash, I need not impair it. However, value in use of the damaged machine, if it is independent, yes, I will impair it. If independently can earn, I will impair. If it is a part of the CGU, and if I continue to use it, okay, then I don't charge the impairment. So if my intention is not to discard it, not to sell it, but let me continue to use, that means it's part of my CGU and it will continue for getting generated, and that impaired asset along with the damaged asset. Like suppose there are some group of animals, one of the animal gets what is the injury. Now question comes, whether that group is going to leave that or group is going to take it, something like that. So now if you plan to discard it, abandon it, yes, definitely you have to impair, because you have got a fair value now. Fair value is the best estimation of recoverable amount. But if you plan to continue, then don't impair. This is the theory I told you at that one question, one theory question is there at that time discussed. Again, this question never came in your previous syllabus, but anyhow, understand this, very few 7 or 8 questions are there. So you are going to say that, look, the management is not committed to replace the machine and use it in existing condition. Now can you estimate the recoverable amount? No, because value in use is not there. I don't know, because since I am continuing to use it, see, it is damaged. If I want to sell right now, I will get the fair value. But since I am continuing to use it, what is its recoverable value? I don't know. So in that case, I will test for the impairment of the CGU, and if the CGU is not impaired, I will not recognize the loss on the machine, but I will revise the depreciation period or the method so that I can consume that asset fast. Understood this? This theory is clear. Alternatively, if I decide not to use this machine anymore, then one thing is very clear. What is my value in use? 0, because I have kept it separate. It is not part of my CGU anymore now. What is my fair value less cost to sell? Definitely I know my fair value. See, previously fair value I knew, because if I call one customer and say, oh Baba, I don't want this fan, how much in OLX, how much you take, they would have told you. But what is the value in use? Do you say 0? No, because I am continuing to use it, even though it is damaged. But the CGU as a whole is not impaired. I mean, understood no this particular theory. That's why I don't impair here in this circumstance, since my intention is very clear not to use it anymore. So this is 0. What is my fair value? Some X amount. What is recoverable amount? Whichever is higher. Yes, that's why if I am going to machine's recoverable is less than the carrying amount, I am going to impair. Clear? Yes, next question. See, this is a beautiful question, very nice new generation question. Previously it was an RTP question, but in new syllabus they have added it to your study material as test your knowledge 15. See, again I said 32 questions somewhere are there, which was part of RTP MTP. Since in the old previous syllabus they have almost exhausted very beautiful big questions. So top priority you have to give to these questions, which was sitting as an RTP question. And tricks you know that. If it is simple, don't be happy. In the examination, you wait for some twist. And what type of twist? See there. If it is complicated, for example, like this, confusing, expect that this question may come as it is, just changing the number. Clear? Okay, so now we will move on to the next question, important question. One of the senior engineers of XYZ has been working on a process to improve the manufacturing efficiency, consequently reduce the manufacturing cost. This is a major project and has got a full support of XYZ board of directors. Again, at this point of time I should tell you, this is an L3 question, because this has got application of Ind AS 38, which you are yet to do. Okay, online students, if you have done what I will do, I will place the Ind AS 38 before this, so that you can get the application of this. Anyhow, I'll explain you that Ind AS 38 thing. The senior engineer believes that the cost reduction will exceed the project cost within 24 months of its implementation. That means you are going to get a break even. Regulatory testing and health and safety approval was obtained on 1st of June 2015. This removed the uncertainties concerning the project, which was finally completed on 20th April 2016. Now the cost of 18 lakh rupees was incurred till the year end 31st March 2016 have been recognized as an intangible asset. Yeah, is the Ind AS 38. Your intangible asset is applicable here. Now you need to tell me, okay, can I really recognize it as an intangible asset? And okay, when it's an intangible asset, is it subject to an impairment? Am I supposed to do an impairment review? Which one? See, in impairment, there are two types, in intangible asset, there are two types of impairment. One is my normal intangible asset, which I am amortizing. I have to test for impairment only when there are indicators. But there is one intangible asset which is not yet available for use. I have to test impairment every year. Now, an offer of 7,80,000 rupees for the new developed technology has been received from the potential buyer, but has been rejected by XYZ. So, some offer, somebody said, okay, give me this technology, I'll give you 7,80,000. But XYZ said no. Utkarsh believe, no, who is Utkarsh? One project manager, that the project will be a major success and got a potential to earn 12 lakh rupees in perpetuity. What is this 12 lakh rupees? Value in use, in perpetuity. Now, the director of research, XYZ, Neha. Okay, Utkarsh is an engineer, and there is one director, Neha, who is a qualified electronic engineer. She is also one qualified person. Is seriously concerned about the long term project and the opinion that the computer would have developed that technology in some point of time and would require the new process within 4 years, required to replace within 4 years. That means she is telling, what nonsense you are telling. Is this an intangible asset with the perpetual life? It is only that song can be, okay, you are perpetual forever. That Purandarasa song I told. This technology within 4 years somebody is going to replace, and it will become old technology. At that time, 20 years back, it was fantastic technology. Mobile phone, which is the cordless mobile phone. Today you don't see also cordless. After mobile phones have come, that telephone phone was there, no? Now she estimates that the present value of the future cost saving is 9,60,000. After that, she thinks that there is no certainty about its future. What is your advice? Appropriate accounting treatment for the year ended 31st March 2016. Now, what is this 31st March 2016 now? Now, when did you regulatory testing upload on 1st June? And this removed the uncertainty, and it was completed on 20th April 2016. Now, on 31st March 2015, what it was? And advice, okay, what did you understood with this question? I would like to first discuss before I go into the solutions. They said what? Advice. Do I need to write theory? Yes. And when they use the verb called advice, what does that mean? There must be some confusions. Analyze, there must be some components, and you have to speak about the treatment of the components. So what is that advice? What is the confusion here? Advice, the accounting treatment of aforesaid issue. See, they only said there is one issue for the year ended 31st March 2016. Yes, tell me what you doubted. What is the issue here? What is the issue? Is there an issue or is there no issue only? Yeah, very clearly evident, no? What issue did you observe? Sorry? Should we record intangible asset or not? That is the issue. Is there a confusion? Is there any argument on that? See, if you see this, they said very clearly and categorically in this question. That's why you have to catch the word, because I love this type of question. This type of questions you may expect. Confusing, no? There are some questions which they didn't ask till now in the exam, because I know, but hardly very 5% I can say questions like this. But possibly they may ask you simply to confuse. There is nothing, okay. Ultimately, once you are thorough with the concept, what is this? Did you say that this removed the uncertainty concerning the project? Okay, on 1/5, your uncertainties went off, and you completed it on 20th April. So what does this mean? Sorry? Research and development you are talking. Yeah. Somewhere I can say it is like a research and development. But argument is not on that. Argument is where? Life of the intangible. What is your opinion? What you would have done? Suppose if they would have come to you, you are a practicing CA or you are the auditor of the company. Which company would have preferred? Tell me. Suppose company, okay, is it a life of the intangible asset? Okay, because of the life, what it is impacting? See, there is no argument related to should we test every year, because by 31st March 2016, is this project complete? No. Are we supposed to test impairment? Yes. There is no question about that, no. There is no confusion about it. And nobody is arguing that also. But there is one issue. That is the issue. Okay, yeah, obviously, no. After they got here, they will start capitalizing the cost. But the confusion is regarding that. Then what is the confusion? They said very clearly issue. See, understand? You have to interpret the question. They said issue and advice. So what is the issue? That's my question. Sorry? Win the indefinite life. So what is the impact? Okay, if you are a company management, what you would have chosen? What you would have preferred? You do go with Utkarsh or will go with Neha? Neha, I would like to go with Utkarsh if I am a cunning management. Why? I need not impair, no? No hit to my P&L account. More than calculate. That's the issue, no? And calculation of value in use is one of the prime ingredient in my impairment, no? So ultimately this question will revolve around impairment. But this is an L3 question because it brings certain elements from your other chapters, other standard. But the prime issue here is an argument happening between Utkarsh and Neha. Utkarsh says this is value in use is perpetual. Follow? And what is the present value of this perpetual? What is the present value? This is what 12 lakhs every year I am going to get. What is the present value of this 12 lakhs? See, when we talk about value in use, are we not supposed to find out the present value? They didn't give me the discount rates. Now where we should look for? AFM we should look for, because how to find out the present value of a perpetual bond? Divide this income divided by the capitalization rate, KE, expectation. But they didn't give me that, okay? So leave it. Now the discussion is whether should I take whatever present value of this 12 lakhs or whether this 9.6. Which one you would have taken? 9.6, because this makes more sense here. Because otherwise I would now never impair this. Okay? So now your answer will be like this. First of all, the cost incurred to develop the process can be capitalized as per Ind AS 38 because it is identifiable. How do you know identifiable? There are two elements for identifiability. It's called a contractual or separable. Is this process a contractual or separable? Separable, because somebody offered, give me that technology, I will give you. Yes, it will give you future economic benefits. And you can measure the cost 18 lakh. And because it is an internally generated this thing, we have to check for the conditions for capitalization. Like, is this technically feasible? Do they have the intention to complete? Can you measure the cost? Can you get the benefits? And we see that all these conditions have been fulfilled from 1st of June 2015. Now, because from first, assuming that this cost is evenly incurred, this is an assumption, we distribute 18 lakh into 15 lakh and 3 lakhs. 3 lakhs we will take to P&L account, and 15 lakhs we are going to capitalize. So as at 31st March 2016, my intangible asset work in progress is 15 lakhs. Are you clear? Yeah, this problem we didn't solve because majority was the theory. So that's why I thought to give it to you. You understood, no? Next part of the question, okay, maybe in the examination may they twist this, okay, and they may ask you more. Otherwise, if this question comes as it is, this part has to be written. Or maybe they may ask you about the confusion about the capitalization also. This capitalization can be done. Next is the impairment. Okay, impairment assets, intangible is not available for use, should be tested for annually. Value in is 9 lakh 60 because Utkarsh doesn't make like sense that technology will remain forever. So you would have gone with the Neha's assessment. Fair value is 7.8. So your difference between higher of this 9.6 will be the value in use, and you will take impairment loss of 50. Thus you will be passing one accounting entry. 3 lakhs you will take to development expenditure because you must have capitalized. Okay, impairment loss 5.4 and 8.4. So now in the examination, okay, or not an examination, yeah, one more issue is there, students. Actually there are two issues. Yeah, I think what you said is right. Capitalization is also an issue because they incurred a cost of 18 lakh and have been recognized as an intangible asset. This is one of the issue. That's why we wrote that first part of the theory. Yes, it is an intangible asset, but not the full part. Understood, no? So in one question, that's why I call it an L3 level question, because in this one question, two issue of two different standards are sitting. The first portion is they made one wrong capitalization of 18 lakhs. So you have to reverse 3 lakh. Second issue is the impairment needs to be done. Of that impairment, you have to split, you have to decide which is the recoverable amount. Are you clear? So finally, they may ask you a journal entry also. So you will pass this particular entry and you will close this. Yes, sure. Are you clear? Okay, clear? Any doubt? Anything you want to discuss? Yes, Shruti. Question, okay. See, again, I love to discuss question. You have to be very clear about the question. So now you are able to see very clearly two issues. Yeah, we are assumed here that this is an assumption setting that this cost of 18 lakh incurred till when they said, it is assumed that it is taken from the 1st of April. It's an assumption. So maybe in the examination, alternatively, I have shown you the big assumptions they take. So if you take this assumption that this cost is incurred from 18 lakh, that means their treatment is correct. Then why you should explain all those stories? There is no issue only, no. So then the issue will be only second one. So this issue, the first issue, is very silently sitting as an assumption. That's why in a very plain reading, we will not be able to identify that issue in the first reading. Somewhere when we look at the solution, then we understand, oh, there is one more issue sitting there. Correct? Okay, clear? Yes, so next question is on the identification of some CGU. Again, this is also added in your new syllabus now as a new illustration, even though it was not previously RTP, MTP, it was there. Now, a significant raw material used for plant's Y final production. A significant raw material used for plant's Y final production is an intermediate product bought from plant X of the same entity. That means you have got some profit centers or whatever. X produces some material, say something, and that will be used as a final product for Y. X products are sold to Y at the transfer price that passes all margin to X. 80% of the Y's final product are sold to the customers outside the entity. Understood the circumstance here? You have got an X. This is your plant. This will give to Y. Now you transfer how much X products are sold to Y at the transfer price, and 80% of the Y's final production is sold to customer outside the entity. Maybe other Y it is sold inside somewhere, they must be using it. Now 60% of the X final production is sold to Y, and remaining 40% X is independently selling to customers outside the entity. Understood now? Now evaluate the CGU for X and Y. If X could sell the product it sells to Y in an active market, and internal transfer prices are higher than the market prices, what are the cash generating units for X and Y? How many cash generating units are there? Is X and Y together, or X and X is different or Y is different? How many CGUs are there in the first instance? 1, 2. Question is clear? Okay, let us again go back to the question. This is the scenario you sell 60%, 40%. 60% is given at a transfer price. Now they say that what you need to do is you need to evaluate the CGU for X and Y. If X could sell the products it sells to Y in an active market, that means what you are selling 60%, 100% you can sell in the, or maybe there is one specific specification that 60% you are giving and 40% others. What you could have sold to Y, you could have sold to some third party this 60%, and internal transfer prices are higher than the market prices. What is my cash generating unit? If there are no active market for product of X, what is my CGU? This is 1. But if you can sell to the third parties, internal transfer prices you forget, but can you sell to the third party? Is it an independent? Yes. So, okay, you can have 2 CGUs. This is the thing, very simple. So question number 1, cash generating unit X could sell to active market which is independent of the cash inflow from Y. So X is a CGU. Y is also a CGU because it sells 80% of the customers outside. Again it is independent. So effect of the internal transfer pricing, one twist they added here. Internal transfer prices do not reflect the market price for the output. Therefore, when you determine value in use for X and Y, you need to adjust the financial budgets to reflect the management best estimate of the future prices that could be achieved in arm's length transaction for those X product that are used internally. So look for arm's length prices, okay, because your internal prices you can set it anything for your accounting purpose or whatever your MIS purpose. So that may not reflect it. So you have to look for arm's length price when you talk to about deciding the CGUs. Now, if it is likely that the recoverable amount of each plant cannot be assessed. It is like machine B, A and B example we discussed. A is like Y, which is independent, but B is not independent. B has to give its output to A. Then what we have done? We have taken A and B together. Like this, X and Y has to be taken together. Majority is used internally, could not be sold in the active market. X cannot generate independent cash flow, so 2 plant has to be managed together. Likely X and Y may be the smallest asset groups. Clear now, students? Okay, one last question is there. Yes, so before we proceed this question, I just remind you one more thing. We discussed about this carrying amount of the CGU. We discussed that it should be directly attributable, allocatable on reasonable basis, does not include any liability except decommissioning. We discussed that, no? Then I gave you an example also, like how it works, what is the purpose of excluding this. Okay, I'll just remind. So you have got an asset here. This asset, okay, net asset is 500. When we look about the fair value, it will be including restoration, because whoever got me a quotation would have been including decommissioning liability. And when we find out the value in use, it is only of the assets we find. So standard says that, look, if this liability cannot be separated from the asset, you deduct it from the asset also, deduct it from value in use also, so that you can have a meaningful comparison. So maybe one theory is there, okay, probability is low. Just see again at the end, in this theory you have to make your judgment, which one you need to focus, because every theory may not be that important. Like previous two theories, added, updated in the new syllabus, important. You see theory with the numbers, important. Now company operates a mine in a country where legislation require owner must restore the asset before the completion of the mining operations. The cost of restoration includes replacement of the overburden, which must be removed before the mining commences. Provision for the cost to replace the burden as recognized as soon as it is removed. So this is the story, and they say that there is a decommissioning liability. The amount provided was recognized as part of the cost of the mine. Is it correct? What accounting entry they must have passed? Mine to decommissioning liability as per Ind AS 16, and being depreciated over the mine's useful life. Yes, PP will get depreciated. What about this provision? Unwinding of the discount. The carrying amount of the provision for restoration is 500, which is equal to, see now it makes sense, no, when you read this. If you do not have done Ind AS 16, then you will not appreciate what you are reading here. See now it is very clear to you, yes, this 500 is nothing but the present value of the restoration cost, which is going to be incurred 10 or 40 years from now. So we don't have any business here, just there is one story. The entity is testing for impairment. Now comes the issue. The CGU for the mine is the mine as a whole. Yes, now it makes sense. What is the meaning of this sentence? CGU of the mine is mine as a whole means what? What did you understand? None of the individual assets can earn any cash flow, and cash flow comes for the mining, like tipper, building, excavator, mining, land as a whole. The entity has received various offers to buy the mine at 800 rupees. What is this? Fair value. And why you are testing impairment? Am I supposed to test it every year? No, only when there is an indicator. The price reflects the fact that the buyer will assume the obligation to restore overburden. Obviously, can I separate this restoration from the asset? And I say that, okay, only restoration you take, asset I will keep, or asset you take, restoration I will keep. No, somebody who takes over this asset should take over the liability also. And this 800 reflect that somebody has already considered it. Now the disposal cost of the mine are negligible. This is cost to sell, otherwise you would have minused it. The value in use is 1200, excluding restoration cost. In examination they may not give you. What you will assume? We will assume that it is generally excluded, because whenever you calculate restoration cost, you remember in Ind AS 16 only we came across. There is a two types of valuation, gross valuation, net valuation. That nuclear power plant was there. Generally when you call these people to find out the value of say nuclear power plant, whatever, or mine, they may give you a fair gross valuation, that means asset as a whole, or net valuation, where they will net it off. But when they give me net, what I am supposed to do? I have to add it back. Correct? So let us assume that this is a gross, and the carrying amount is 1000. Now what is the impairment loss to be accounted? What is supposed to do? Recommend the impairment loss to be accounted. Is there an impairment loss? Yes. What is your recommendation? Your recommendation is this 500 needs to be deducted from here, that's it. Otherwise it becomes a meaningless comparison, that 800 rupees you are comparing with 1200, and 1200 you are comparing with this, where one liability is there, somebody has to take that liability also. So this is the theory. To write it I have given in a very nice format, so that just write this is more than sufficient for your exam. It may be necessary to consider some of the recognized liabilities where the buyer is going to assume. So in the given case, carrying amount of such liability is 500. So you have to minus it from 1000. So restoration cost book value becomes 500. Now the recoverable amount is 800 fair value, where they have considered restoration cost, but valuation Value in use is not considered. So again you have to minus so that you get the value in use 700. Recoverable amount is 800. Thus there is no impairment because your recoverable amount is greater than your book value. Followed, no? Yes. This is again very low probability that they may ask you, but they may ask, yes. Yeah, please. 1000. Not remeasurement. My book value of the mine is 1000. But on the liability side, there is one liability. Generally, when impairment is going to happen, I don't consider the liability as part of my CGU. No, that's what. See, whenever impairment happened, we have done already so many problems we have done. Any of the problems have we considered liability there? We considered stock. We consider allocation of the goodwill, corporate assets. But this particular liability we cannot separate. That's what, there is one liability. No? So I will take the book value of the liability, 500. So what is my net book value of this CGU? 500. This is applicable only and only for those liabilities. That's why I start this answer with this. It may be necessary to consider some recognized liabilities, not all liabilities. None of the time you consider except this particular case. So whenever you do this, maybe in the exam they may twist the numbers, impairment may come to you. So you have to tell, okay, in this case what we answer we wrote, no impairment, you have to do calculation of impairment and say this much impairment will be incurred and this will be charged to the P&L account. Are you clear? Sorry? No, it's not that is, see, reversal of decommissioning liability is a separate concept which is dealt by Ind AS 16. That accounting, okay, that depends upon whether when you reverse the decommissioning liability, whether it is a cost model is followed, revaluation model followed, that is a different story. Here, you are trying to impair it. Okay, now more questions may come to your mind. I am understanding, I am feeling that what is going on in your mind. But what I can suggest you at this point of time, yes, if you have understood this concept that what I am supposed to do, fine. When you become a professional, again you may face this problem because maybe your mind is thinking that impairment and this change together. But I told you, I say will not do that. One question is sufficient, no? An impairment and change in the revaluation together to make us confused. So that's not going to happen. Don't worry. Just focus on these small concepts right now. Just small concepts. Just focus on. No, we are not, see, accounting entry is going to come from 16. But when you need to pass P&L account debit, impairment to CGU, you need one number, no? That's what, there is no issue related to any decommissioning liability. It is neither the decommissioning liability has got changed. Those questions are not there here. Here simply they said that there is one asset which we need to test impairment and there is one associated liability. That's it. We have already considered. See, this liability is already at a book value. There is no change. Everything is fine. If impairment was there, not there, no accounting entry would have been there. Now the indicators of impairment came here. When you indicate impairment, now only one issue. Will you include this liability as part of the CGU or not? Yes or no? And that's what, again, I want to spend time, students, understand. Here, they didn't ask you anything on Ind AS 16. Not there, that in future the amount got changed. Here, simply they said that entity is testing for impairment. What do you mean by that? There is an indicator. So, only one question I am going to ask you. When entity is testing impairment, will you impair 1000 rupees or will you impair 1000 minus 500 rupees? Why? Because this liability cannot be separated. That's your answer. If at all you could have separated this liability, like you have taken one bank loan for this is what we discussed. You have taken one bank loan for this mine. Will you include that loan also? No, exactly. That's the answer you need to write. Perfect, everyone? Yes, students. So with this, we are completed. Come on. Yes, thank you. With this we are done with impairment also.